Okay, everyone, so we're moving on to Chapter 5, Governance Scope and Approaches. We should know from just a cursory look, a brief look at past SBL papers, that the area of governance is key to us. It's key to your success. We must have a firm grip on this particular chapter. In terms of hot topics for the SBL exam, I would always put governance in my top 5 or 6. Absolutely. So let's move on to the first section and see what we have. We're referencing here investors and indeed compositions of shareholdings. This area of institutional investors is certainly one of the core parts of governance. Why? Because institutional investors hold power. They hold power in listed organizations, but they also invest in private companies. So in terms of the types of institutional investors that we would come across generally in questions, quite a variety. Insurance companies, pension funds, mutual funds, etc. And note that certainly many institutional investors will be pooling funds and indeed acting on behalf of other investors, of course. So there's a sort of an agency relationship there in many different ways. Now, in terms of the sort of impact or power, if you will, that institutional investors can have, particularly on listed companies, it's quite significant. So, if you will, when we look at the sort of composition of a given shareholding, let's say within a typical listed company, is going to be fairly high. Certainly in my research, and you'll see that I've given you a stat here, in 2010 in the US in terms of listed companies around about 67%. Certainly my research outside of that would suggest that broadly speaking, in most markets, in most regulated stock exchanges, the figure is going to be somewhere between about 60 and 75 or thereabouts in terms of the makeup of shareholdings within listed companies. Moving on from there, in terms of how we see, their sort of influence and indeed what can they do, a variety of different things. I guess in one sense their overriding concern is performance, as you would, in a sense, with a private individual. Shareholders are interested in a return. They're interested in the maximization of their wealth. And indeed, the C-suite, the board of directors, should be or should have that at the forefront of their minds. So what institutional investors would be inclined to do in the first instance is monitor the performance, and indeed linked into that, obviously monitor the board in terms of their actions, their strategies, and indeed just about everything. Now, subject to 1 and 2, clearly with institutional investors on average making up between 60 and 70% or thereabouts of many listed companies' shareholders, they have a significant amount of influence. So they can hold sway, as it were. They can vote against or for different propositions by the board. In addition to that, number 4, when I say active governance, in effect what I'm talking about is governance in a sense from within the company. So we know from the sort of normal use of the word governance, corporate governance is about direction and control. But generally speaking, when we refer to corporate governance, we're talking about the regime that exists outside the company. And that forms or is formed by many different things. Perhaps a corporate governance code like the UK code, perhaps Sarbanes-Oxley in the US, which is in effect a rules-based situation, or indeed maybe stock exchange regulations. But what we're talking about here is really this influence, this active governance is coming from within. So institutional investors, because of their number, because of the percentage holding they're likely to have, are in one sense on a day-to-day, week-to-week basis providing that active governance role. They're involved in monitoring the performance, monitoring the board, etc., etc. More so than, say, an individual investor would be, a private person like you or I. Moving on from there, in terms of potential problems, just because we have a large group who hold sway, who have a significant shareholding in the company, all is not always all well. First area to consider in terms of the involvement of institutional investors in a, let's say, a listed company, is that it's possible that, let's say, the investment fund managers, their earnings are not necessarily linked to company performance. And what I mean by that is we have investment managers, let's say in a pension fund. They will be investing on behalf of their shareholders and their investors in a variety of different companies. But it may well be that they're not overly concerned about the performance because their earnings are not linked to that company's performance. So in one sense, that's a sort of a three-legged dog. Yes, they're involved, but are they overly interested? So, what's the solution? Well, perhaps let's make sure that investment managers, whether it's a pension fund or a mutual fund or whatever, let's make sure that certainly their earnings are linked in some way. Second one down here is, conflict of interest. And we've touched on that in other areas of the course. It may well be that there is in some way involvement of, let's say, an investment manager within a given mutual fund, involvement personally, in, let's say, the shareholdings of the particular target company. I mean, that's not a good idea. It's not a good idea. Where we have conflicts or the possibility of some bias on behalf of these individual managers, this is not a good thing for anybody. It's not a good thing for the pension fund or the mutual fund. It's certainly not a good thing for the company itself. Last point is, nice little phrase here, can be used in a number of different ways across the SBL exam, short-termism. So what we mean by that, if you're not familiar with it, is just the idea that individuals, perhaps investment managers, perhaps other individuals, will act with a short-term interest. In other words, perhaps institutional investors might be after a very, very quick return on their investment. They're not interested in investing in this company as an institutional investor for the long term. And as a result of that, they make the decisions, perhaps in terms of voting or something else, which is very much short-term based. It's about short-term profit. And really, when we think about concepts such as maximization of shareholder wealth, invariably, there's a long-term element to that. It's very rare that you would get short-term thoughts and alongside long-term shareholder wealth maximization. So there are some issues associated with, I guess, the involvement of institutional directors. So linked into that, and in relation to section 2 here, let's talk about, a sort of organizational ownership. And what I mean by that is certainly, as we see here, governance or corporate governance in different countries can be influenced by the type or indeed style of ownership. Now, let's delve into that a little bit further. What I mean is, firstly, certainly how companies finance themselves. I mean, obviously, companies have a choice, don't they? They have a choice between equity and, let's say, debt. In addition to that, the structure of corporate ownership is different from country to country, and indeed is influenced by a number of different factors, as we are about to see. So given that, and given that we're saying that corporate governance can be influenced by perhaps a country's history, its economics, and its general attitudes within business, what would be the main sort of possibilities in terms of types, or, if you will, styles of ownership? Well, the first one is sort of family firms. Now, you'll find this aspect in places like South America, Asia, for certain. And indeed, what we mean by this is certainly listed entities, so entities that technically are publicly owned, but that broadly speaking are controlled by large families. When I say controlled, I mean broadly owned by family firms. And you find this, as I say, in South America a lot, and in Asia. Now, that type of ownership, bear in mind, we are talking about a listed entity. We're talking about a publicly traded entity. Now, in that scenario of ownership, this is known as insider systems. We're talking about wealthy, long-standing firms, perhaps involved in a particular industry for many, many years, and this is an insider system. Okay, let's look at maybe the flip side of that, where we have what's referred to as dispersed ownership. In other words, ownership that is wide-ranging. That would be pretty common in the UK and the US. We're talking about people like you and me, some families, institutional investors, etc., etc., etc. We're talking about ownership that is very, very broad, known as outsider systems. So on the one hand, insider, on the other hand, outsider. So let's delve further into this now. So insider systems, so South America, Asia, etc. What would be the benefit to systems such as that? And indeed, what would be the impact of sort of ownership in that style on corporate governance generally, and indeed the running and management of businesses? Some advantages and indeed some disadvantages. The first area, I guess, in one sense, and this is subjective, people might have different views on this, is it's suggested that agency issues are, slightly less of a problem. Let's think about it. If we're talking about, let's say, a business in a particular industry in South America, in Argentina, for example, if we have strong family shareholdings, a significant portion of the shareholding of this listed entity being family owned, then it may well be that we also have a high degree of influence on the board or the running, through family members. There may be a person involved on the board. It could be the CFO, etc., etc. So, in essence, what we're saying is that agency problems would be reduced. Now, we know from our studies that agency simply means the relationship between an agent and a principal. So in the normal course of events, we're saying, okay, the agent of a particular listed entity is the director or directors. The principal is are the shareholders. So broadly speaking, if there's an overlap or a parallel or a crossover between the two, then it's probable, that we have less potential for conflict, less potential for perhaps directors acting in their own best interests. Second one, long-term view. Again, I buy into this because I think that if you have a family entity, a family business that's been around for many, many years, despite the fact that it's listed on a stock exchange, they're more likely to take a long-term view. And that will probably mean they're more likely to sort of move towards shareholder wealth maximization. Okay. Third point, strong ethics. Now, this is, if you will, this is certainly subjective, but, in essence, think about it, that if we have, a large influence on a listed company in Argentina or elsewhere, and indeed that company is well known, they have a large shareholding, they've been in the business for many, many years, their honor is at stake. If something goes wrong, if the company is seen to do something wrong, if the board is seen to do something wrong, if they were to act in a significantly unethical manner, the family's name is at stake, and families don't want that, particularly wealthy, long-established families. So certainly some advantages of insider systems where, let's say, one family, or maybe more than one family, is involved in a company as significant shareholders and possibly also in management. On the flip side, certainly there are some disadvantages as well. We know, if your family is anything like mine, that, family feuds, family disagreements, disagreements between family members are very, very possible. That can create significant problems for the running of the business. And indeed, if we look in the press over the years where we have a family involved in a listed business, and indeed in all countries, we do see situations where difficulties, conflicts between family members causes major issues for that business. The next area is really minority shareholders. Of course, we're talking here about the idea that we have an entity in Argentina, let's say, that's family controlled, been around for many years. It will be a listed entity. That means that there must be minority shareholders. Their voice, when they're up against a very, very powerful, well-known family that's been controlling this entity for many, many years, their voice won't be heard. Highly unlikely. Highly unlikely. So certainly they're going to be disadvantaged in a number of ways. Next key point, invariably, this can happen. This is subjective, but bottom line is that, if you have a family that's been running a business and been a shareholder of a business in the long term, it's unlikely that they have a like for, let's say, a new CEO or a new FO coming in with new ideas, maybe coming in perhaps with modern ideas that go against the way in which the family have run the business or influenced the business over time. So certainly the likelihood of outsiders being welcome at the front door is probably less so. This doesn't mean it doesn't happen, but it's probably less so. And that's a bit of a problem. Fresh blood, independent view, new experience, new expertise, etc., etc. Okay? What about outsider systems? Again, several advantages and indeed several disadvantages. Okay, first things first. With outsider systems, you would sense, and again, we're nearly contradicting ourselves in one sense in relation to some of the points that we made above. But within outsider systems, generally speaking, you would probably expect corporate governance to be maybe better. Again, it's subjective, as I say, really because of the fact that you don't have the influence of one particular group or one particular set of people. Okay? So more often than not within these systems, you would have thought that the degree to which the company accepts, let's say, the impact of the external regimes, UK code, stock market regulations, other regulations, is probably more so. Okay? The next key point is, and this is a tricky one to understand in one sense, frequent stakeholders may control managers. And what we mean by that is certainly in an open market, where shares are being traded, certainly, the idea of shares being traded and the possibility of a takeover by XYZ Group looming would tend to focus directors' minds. This will happen much more often, I would suggest, within an outsider system than an insider system. By implication, an insider system is where a family holds a significant proportion of shares in an entity, broadly speaking, to some extent controlling that entity by the size of that stake. Where we have frequent exchange, sales and purchase of those shares, it's highly likely that takeovers are more likely. So this will hopefully, and I would have thought on a practical level, focus managers' minds on doing the right thing and doing it as often as possible. An element of control there because of the shareholder makeup. Next key area is certainly in this type of system, there will be the involvement certainly of NEDs, but indeed of other areas. And it may well be that on balance, broadly speaking, shareholders, individual shareholders or small groups of shareholders are certainly more empowered. They have more power than they would have, if we have a situation where we have one family or one or two families holding a heavy, heavy percentage holding within a company and holding sway, holding too much power. So really other shareholders, minority even, have much more input or potentially have much more input. What about disadvantages to outsider systems? Again, like we said up top, agency is an issue. We're really separating, aren't we, ownership and control, influence entirely. So it's highly likely that agency costs, and you'll recall from your studies that agency costs really mean the costs of monitoring and indeed contracting with agents, i.e. the costs incurred in really keeping an eye on the controllers, controlling the controllers. It's highly likely within an outsider system for those costs to be higher. What about the next point? Certainly to some extent minority shareholders can be disadvantaged in this sense also. And indeed, larger shareholders probably more likely to exit more quickly. We mentioned up top in terms of, takeovers, but, with outsider systems, certainly the shares will be traded, I guess, much more frequently, much more rapidly. And it may well be, as we mentioned in relation to institutional shareholders, that perhaps they would tend to sell their shares, not necessarily in the very, very short term, but they certainly tend to be selling their shares on a more regular basis because of the system. That means that there's some element of, I guess, disruption because of the fact that the shareholding in this outsider system listed entity is spread or indeed dispersed widely. In particular, larger shareholders may sell more quickly. That may create a little bit of instability, imbalance. Okay? Let's move on from there in relation to corporate governance codes. Now, we know from our studies that, broadly speaking, we're going sort of two ways with this. Let's look at the first key area, and that, let me just go back a bit, is, as we know, principles-based approach. An approach to corporate governance based on a set of principles, not based on a set of rigid rules. So let's look firstly at the characteristics of a principle-based approach. So invariably, point number one, there's a focus on objectives. In other words, there's a focus here on the objectives of corporate governance and what it's supposed to do. In other words, it's supposed to direct and control operations or assist in the direction of control or assist in the management of control. So there's a focus on the objective. Linked into that, we find that when we look at codes across the world, certainly, principle-based codes, just because they're principles, tend to be as comprehensive, if not more comprehensive, certainly because of the comply explain rule, as rules-based. Next key point is, and this is an advantage certainly that principles-based codes have over rules-based. They are flexible and adaptable. In other words, if you have a set of principles or guidelines, it's probably easier for individual companies, for boards of directors, and indeed for regulators to adapt those guidelines, those principles around different businesses, around different situations. Contrast that with, let's say, a rules-based approach, which is very fixed. It's a sort of a cookbook style, okay? The fourth point is, again, and this is very, very important, I feel, in terms of what underpins principles-based approach, is the old comply or explain issue. And what we mean by that, we'll know from our studies, is really what companies are encouraged to do is certainly to apply the principles to their situation. But if they are unable in some way to comply with a given principle or a given guideline, they're required to explain that in their annual report or in some other fashion. So comply or explain is an excellent way to sort of, in one sense, catch all. because in the first instance, you're providing guidelines or principles that are required to be interpreted, wrapped around individual companies' situations. But then, secondly, what you're saying is, okay, well, there may be situations, scenarios where you find it difficult to interpret or difficult to adapt these principles or guidelines around your company or around this transaction, etc. If you do, then you need to disclose it. You need to explain it, okay? Last key point in terms of characteristics is, unlike what some would suggest, rules-based approach, let's say in the US, SOX, there's no box ticking going on, or a sort of an attitude that, if in doubt, tick the box. The use and the application of these guidelines or principles-based approach requires evaluation and requires application, not just tick the box and we'll be okay. So there's the characteristics. Let's look at what you might perceive as the advantages. And there are several, but there's also advantages to a rules-based approach. First one really is the idea, let's go back a bit. First, the idea is, as I said up top, these principles or guidelines allow for application to any business, to any size of business, to any situation invariably. And we have the comply or explain rule to sort of as a fallback position. So there's a great degree of flexibility there, okay? Second key advantage is really, as I've mentioned, this sort of catch-all idea. If you can't apply, if you can't wrap the guidelines or the principles in some way around your business or one element of your business or a transaction or a scenario, then you have to explain. You have to disclose that. So that provides a sort of a net, as it were, that sort of just about catches everything, okay, or should do. Next key advantage is regulation overload or the avoidance of it. Certainly businesses, whether or not they're on in the North American continent or in Europe or indeed elsewhere, face a tremendous amount of regulation, a tremendous amount of legislation. It's costly and it's difficult. So the idea of a principle-based approach, which allows for interpretation of the principles stroke guidelines, just eases the burden in one sense. It doesn't mean that businesses on this side of the Atlantic who approach governance on the basis of a principle-based approach doesn't mean that they can avoid corporate governance, not at all. It just means that at least one aspect of regulation has been eliminated. Okay? Let's move on from there in terms of criticisms. What are the problems, given what we've said about this approach to corporate governance? I guess the first thing is broadness. We've said that the UK code or other principles-based approaches are certainly very, very comprehensive. But there is an argument to suggest that because they need to provide the ability to adapt to different businesses, different industries, different sizes, etc., it may well be that they're overly broad or too broad. In addition to that, and this is an interesting point here that it nearly contradicts the first point. Some would suggest that really the principles and the guidelines, because they're so comprehensive, in one sense, are really rules, particularly when you sort of add in the idea of comply or explain. They're very much rules that you can't get around. Now, when I say comply or explain confusion, what I mean by that is that you're putting businesses in a position where things are adaptable, yes, but they may be slightly broad, and you're asking them to really explain situations where they haven't been able to sort of adapt or indeed apply these key guidelines and principles. That can be confusing for businesses. I mean, not all businesses have expertise in terms of the legal side or expertise in terms of the application of guidelines or indeed principles to every single transaction, to every single scenario. So the problem with comply or explain, because it's not quite as precise as, say, let's say a rule or a piece of legislation, is that it might create confusion for individual CFOs or finance departments, etc. Next area for us is really the idea, let me just go back a little bit, apologies, I went a little bit too far there, is this idea of the ICGN. Now, in terms of detail here, there's a lot of detail. This is the sort of corporate governance network, as it were, and there's a lot of detail here. Do we need all of it? I don't think so. I think what we've said so far, certainly in relation to the principles-based approach, is that we have a good feel for what that approach means, characteristics, problems, advantages, disadvantages. This area here gives us that little bit of background as to, where has corporate governance come from? What was the starting point? So we have this network, this international corporate governance network. Now, this is made up of a number of different stakeholders. I've just given you two: investors, academics, but a variety of other stakeholders, including, for example, shareholder groups, government, etc. So this particular sort of entity or network or body, if you will, has a mission, is really to promote good standards of corporate governance and, note, investor stewardship, really to assist markets and indeed economies worldwide. So this is a body, if you will, maybe a type of think tank, that provides advice in relation to corporate governance and indeed stewardship. Now, if this phrase doesn't make any sense to you, when we talk about investor stewardship, we're really talking about the extent to which, investors, e.g., let's say institutional investors, look after their own shareholders. So pension funds, mutual funds, etc., will have members. They will have people investing in them. So what the ICGN provides with is some extra guidelines, some extra useful information, and indeed assistance and advice. So the ICGN is involved with a variety of committees and indeed in a variety of areas. I've just picked out three for you. I think within the study hub there are probably 8 or 9. For example, the anti-corruption practices working group, shareholders' rights, effective remuneration. So really what the ICGN are providing is just a lot of additional guidance to companies, to the board of directors, to shareholders, in addition to what is already out there. Now, in terms of depth, as I mentioned when we touched on this particular branch, here's the first area. So, here's some principles, as really seen as a standard. This is sort of, if you will, best practice for well-governed companies. Now, I've just cut and pasted this from the study hub, and note that I haven't cut and pasted everything. So let's take a look at some detail here. So this is issued by the ICGN to assist companies, to assist accountants, to assist the C-suite in relation to their role. So if we look at the first area here, I think this is just 4 areas of probably 6 or 7 in this particular section. So this is about corporate governance good practice, generally speaking. Okay, so in terms of the board and the responsibilities, it says, should act on an informed basis and indeed in the best long-term interests of the company, good faith, care and diligence, benefit of shareholders, having regard to relevant shares, including creditors. So if you will, when you think about this and the advice, this is very much good common sense, and we would hope that most companies would be acting in this way. There's nothing unusual, there's nothing odd about suggesting that the board should be aware of their role and their responsibilities, and that their role and responsibilities rest in these areas. What about number 2, leadership and indeed independence? Now, we know how important the tone at the top is for companies. And remember, the area that we're talking about here is governance. So what does it suggest? What do the ICGN suggest in relation to leadership? Well, what they say is, clarity and indeed balance on the board in terms of people, diversity, experience, expertise, etc., and indeed sex. Balance of the board, and executive roles, and integrity of process, to protect minority interests, minority investors, and promote the success of the company. So again, you have to say that this is, common sense. We're asking for leaders to make sure that board membership is balanced in some way, and indeed that, broadly speaking, executive roles are balanced. Let's have the right people. Let's have succession policies. Let's have male and female. Let's have diversity. Let's have expertise and experience both in the industry and from outside the industry. Next area here is composition and indeed appointment. So broadly speaking, what we're talking about here, and this links with number 2 in terms of balance in the board, we're talking about here is how board membership is made up. So really what we're saying here is, they want or they suggest a sufficient mix of directors, relevant knowledge, independence, competence, industry experience, and a diversity of perspectives, so diversity of viewpoints, to generate effective challenge, discussion, and objective decision making. So really what we're saying here, again, common sense, is let's make sure that we have the right people on the board. Let's choose from a range of different areas, certainly some with industry experience, certainly some with financial experience, with legal experience, etc., etc., etc. Fourth point, remember, this is just 4 of a number, guidance from the ICGN in terms of good quality corporate governance practice. So what do they suggest in terms of corporate culture? Now remember, we know what culture means from our other studies. In essence, as per the theorist Charles Handy, corporate culture means really the way that we do things around here. So the way that a business operates in all respects. So what should the culture be? What culture should the board promote to lend itself towards good quality, best practice corporate governance? Well, certainly, high standards of business ethics, and indeed ensuring that the vision, in other words, the preferred future, the mission, i.e. the purpose, and indeed the objectives of the business are pretty sound and based on or demonstrate, its values, the key values, okay? Outside of that, in terms of the culture, it should certainly be effectively communicated. Again, we see this word communication come up on a regular basis in this area of, certainly in corporate governance, but also in things like ethics, CSR, etc. So it should be effectively communicated, good ethical conduct, and indeed integrated, intertwined with the company's strategy and operations, including risk management and remuneration structures. So again, common sense, but really what we're saying is, in relation to the culture, let's communicate well, let's use our common sense, let's act in the right way. Let's make sure that we know the difference between right and wrong and fair treatment, and let's make sure that we link that in to the overall vision, mission, objectives, and indeed values of the business. Okay, so this is, I guess, an extract, as mentioned, from the global governance principles as issued by the ICGN. Now, you will remember up top what we said was, well, the ICGN, they're not just concerned with sort of external corporate governance, they're also interested in investor stewardship obligations. So really what we're talking about there is where, let's say, an investment manager is tasked with overseeing or interacting with a company in relation to, let's say, a large holding. So we're talking about an institutional investor. Well, that investment manager has some responsibilities too. And here's some best practice. So first things first, we talk here about internal governance and foundations of effective stewardship. And let's remember that when we say stewardship, we simply mean that the party involved, let's say in this case, an investment manager, has been entrusted to oversee or to act as a steward for someone else's assets. In this case, a shareholding, let's say, in a mutual fund or in a pension fund. So, in terms of, this area, what we're suggesting is that certainly investors, i.e., let's say, for example, institutional investors, should certainly review their own governance practices to ensure consistency with national requirements and indeed the ICGN principles. And indeed, they should recognize their sort of need to act in the right way in relation to their fiduciary duty for their beneficiaries or clients. So really what we're saying there, again, there's some common sense involved here, is that really, these investors, these, let's say, institutional investors should be aware that they also have a fiduciary duty, in other words, a duty of care, financial care towards their own clients, okay? And they should act in that way, not in their own best interests. The next area is developing and indeed implementing stewardship policies, okay? So what do we mean by that? Well, in essence, what we're saying is that these investment managers, these managers of sort of pools of funds on behalf of other clients or beneficiaries, should certainly develop and indeed monitor and change their own policies. And those policies obviously should be in line with good practice, and indeed they should make sure they're not overstepping the mark in terms of their investment practices. So again, they should act in the right way on behalf of their beneficiaries or client in relation to the investments that they are making for those beneficiaries and clients. Third area here is monitoring and assessing investee companies. So, the suggestion here is clearly diligence is required, when keeping an eye on investments in target companies. They should exercise diligence in relation to all companies within a particular investment portfolio. And indeed, over and above that, they should be spending time to research and assess other new companies, other possibilities. They shouldn't just sit pretty. They should be actively involved in trying to make sure that their portfolio management is top-notch and indeed in line with many of the areas that we've discussed above, ethical good practice, responsibility, etc., etc. Number 4, engaging companies and investor collaboration. What we're saying here is that certainly these investors, let's say institutional investors, should be engaging, communicating with the investee companies in order to sort of preserve or indeed enhance the value for beneficiaries and clients. And indeed, they should certainly be prepared to collaborate perhaps with other institutional investors if there is a situation where maybe there's something of concern. It shouldn't just be, well, it's an us and them situation. So what if they're institutional investors in this target company? We're not going to liaise with them. We're not going to compute it. There should be transparency and there should be open dialogue where necessary and indeed with reason with other investors in this particular business. Okay? So there's the 2 areas for the ICGN. As I said from the off, quite a lot of information. There's a common theme here, isn't there, across the board when we've come into this particular chapter and indeed the section relating to approaches to corporate governance. And many of the themes, hinge on the basics, ethical business practices, responsibility, communication, transparency, tone at the top, etc., etc. Let's look at the next area here. Bear with me 1 second. We've been through all of this. Rules-based approach. Now, as we said up top in relation to principles-based approach, it's a matter of subjectivity, really, isn't it? We know that rules-based exists in a number of places, not least in the US. Some argue for principles-based, some argue for rules-based. So let's take a good hard look at a rules-based approach and indeed what it means. 4 key areas to kick off with. The first one is general characteristics. So clearly, where we're basing a corporate governance regime on law, everything is prescribed. Everything is clear 100%. This is the law. And indeed, as we say in number 2 here, if it is law-based, the emphasis is on abiding or indeed obeying the law. You can't do what you want. You have to obey the law. In terms of the general approach within SOX, it certainly sort of hinges on it like a checklist. This is sort of, in one sense, linked to what I said up top. In terms of one of the advantages, perhaps it is said, of a principle-based approach, that it's not box ticking. Well, some might argue that, this is box ticking. It's about checklists. There are, comprehensive forms, a plethora of documentation to be used in relation to SOX and indeed the application of SOX to a given entity. The bottom line is, in terms of this law and in terms of obeying the law and using this checklist approach, bottom line is you either comply or you don't. It's either compliance or not compliance. So, it's very much black or white. There is no shade of gray here. This is the law. These are the rules. You have to apply them. Okay? So that's the sort of characteristics, or the main initial characteristics of a rules-based approach. So given that, and given what we saw up top in terms of both advantages and disadvantages associated with the principles-based, what are the advantages of a particular country, or indeed for, let's say, a particular entity, using a rules-based approach? Well, several to think of. First things first, it's one set. That's it. Everything is included within SOX, for example, taking the US as an example. We don't need to look anywhere else. If you comply with the rules as prescribed within the Sarbanes-Oxley Act 2002, then you're good to go. Okay, so in one sense, that makes things simple. Okay, outside of that, note that clearly, in terms of breaching, excuse me, a law, this law is backed by punishment. The bottom line is the Sarbanes-Oxley Act, whatever you think of it, is enforceable in law. You can't disregard it. As we said up top, it's black and white. So it can be enforced, and those enforcements may come in the form of many things: fines, punishments, imprisonment, etc., etc. Third key point is, some would suggest that where you have some form of regime that is based on a law, based on legislation, based on a hard and fast rule, then that may give people, certain types of people perhaps, more confidence, not just in the whole area of corporate governance per se, but also in companies. If they know, or of course they will know, that the particular regime, that this particular company that they're planning to invest in is part of a rules-based regime, maybe they'll be more comfortable to invest in that company, in that particular environment. What about criticisms? As we saw up top, there's both advantages and disadvantages to both sides. So what sort of criticisms would we have of a rules-based approach to corporate governance? There's quite a few of these, I can tell you. So the first one is, and we touched on this up top in terms of the amount of time and indeed effort and indeed cost that will be associated with adhering to rules. There may well be a sort of a disparity between the cost and benefit. It may well be that the costs are, far in excess of the benefits to companies. Because bear in mind, in the US, as an example, even if the company is small, it still has to observe the tenets of the Sarbanes-Oxley Act 2002. The fact that there's no exceptions, both large, medium-sized, and indeed small listed companies have to adhere to SOX. That cost could be excessive. Second key point is, I guess it's a point that we could make in relation to any law, any rule. Where there's a rule, or where a rule is introduced, the first thing that some people are going to do is find a way around it. So if something is hard and fast, in one sense, rather than being, let's say, something that you need to apply in given situations, a la principles, guidelines based, then exploitation is bound to come in some way, shape, or form. Linked into that third point, in one sense, these rigid rules are just that. They're rigid rules written in stone, in legislation, in law. To change the rules, to update them, to maybe take account of, let's say, changes in the business environment, takes a long time. To get a law passed in the US takes as long as it does, let's say, within the UK. So there's very little flexibility in terms of changing things quickly. And that is something that certainly I believe that the US government is looking at. Okay. Next area for us is really, bear with me one second, is specifics, appropriateness. When we think about different approaches, I guess different approaches are going to suit different countries, different companies in different ways. So, for example, we know, or probably know from our studies, that the Sarbanes-Oxley Act was enacted in 2002, a year after Enron went down. Now, Enron, if you're familiar with Enron, certainly is one of the biggest scandals, financial scandals ever heard of. And in essence, we were talking about a company that had been filing accounts that were broadly made up for many, many years. This was a listed entity. And indeed, perhaps the worst thing over and above filing accounts and directors and managers, etc., using off-balance sheet finance, and indeed obtaining massive bonuses, is that the auditors of Enron at the time, Arthur Andersen, were also involved, or several employees stroke partners of the audit firm who are entrusted, obviously, to oversee the financial statements and provide a view of the financial statements, were in play, in effect, with the directors. So, rules-based approach, where trust has been lost, because trust was certainly lost in the US, when people found out that not only the directors but also the auditors were in cahoots and had been in cahoots, working together to basically defraud the public, defraud the investors, defraud the US stock exchange for many, many years, trust went out the window. So on that basis, trust comes back perhaps when you do have a new rule, okay? On the flip side of that, you certainly will know that, democratic style countries, not that the US isn't democratic, but certainly in other countries, e.g., let's say the UK, Ireland, etc., where there's an understanding of responsibility, or a deep understanding of responsibility, and indeed that stakeholders have some sort of sway or influence, then more often than not, this isn't bulletproof, but principles-based approaches tend to work better. Now remember, in the race of the US, we had completely, or at least many parties, many stakeholders, certainly the public, had lost trust in the system, okay? So here, what we're talking about is where trust hasn't been lost, but where democracy is in play. Also, there's a strong understanding of corporate social responsibility. In that case, broadly speaking and generally, principles-based tends to work reasonably well. Let's look a little bit further at SOX in terms of the detail. Now, do note that the real detail of SOX is not examinable in the exam. But let's take you through a little bit of background so you're reasonably familiar with it, just for the purposes of the exam, in terms of understanding even more a principles-based approach. So first things first, it was on the back of Enron, i.e. the company that I've just mentioned, that hit the deck in 2001. So within a year we had SOX. Okay. Now, all organizations, all listed organizations, doesn't matter how big you are, must comply. You know, we know that in the UK, in terms of the principles-based approach, certainly only listed companies are required to comply. Now, in terms of the possible penalties, they are severe, many, and indeed varied. You do not comply with SOX. If you're a listed company in the US, then you're in big trouble. And there have been certainly many examples of severe fines, severe penalties for entities and indeed individuals who were involved in non-compliance. One of the problems, I guess, in one sense, there's no leeway for error. You know, as we said up top, you either comply or you don't comply. That makes things very difficult. And indeed, it makes things very costly for all businesses, particularly smaller businesses. It's a major problem for smaller listed entities. Okay, so, you know, in terms of sort of impact, you know, in one sense, a rules-based approach, unlike a principles-based approach, does assume that one size fits all. It does assume that, in essence, you know, regardless of your size, industry, et cetera, makeup, as it were, you know, this law, you're going to have to make it fit in one way, shape, or form. That makes it, in my view, and in many observers' view, much more difficult, because one side does not always fit all. You know, the next area that's of importance here, certainly for FDI and businesses operating in the US, is that, you know, it does apply to even foreign companies who are listed in the US, or indeed foreign subsidiaries. So there's no get out just because, let's say, you have a strong connection with your home country outside of the UK. If you are listed in the US, that's it. You have to comply with Sarbanes-Oxley. That's it. Okay, next key point, as I've just mentioned, my apologies. Next key point is, just as I've said, you know, the key details as listed within the study hub are not examinable in the exam. Now, I think it's worthwhile just taking a quick look, but do remember that you're not going to get asked specific questions in relation to provisions of the Sarbanes-Oxley Act. Okay, having a broad understanding helps, so I'm not suggesting just simply avoid that section of the study hub. I would take a look at it. Okay, so really there we have it then in relation to Chapter 5. We've covered quite a lot of content there in relation to governance. I hope that you found it helpful. Let's follow up our understanding with question practice. Let's remember that question practice is how, over and above making notes, watching videos, listening to me, question practice is how we really sort of, you know, really deepen our knowledge and sort of be ready for any style of question on behalf of the examiner. Okay, so thank you for listening. Good luck with your studies. See you on the next chapter.